All righty, it is Fed week. We've got some inflation prints, some jobs numbers. We're going to get a dot plot or SOP this week. We're going to talk with Taylor from Life Goal Investments and say what he's looking for, what might be a curveball, right? Kind of unexpected. But yeah, let's get into it. So Taylor, as you sit here Monday morning, what is your kind of base case for Wednesday after Jerome Powell, finishes his Q&A? What do you think happens, if anything?
Yeah, so I think I've been on the opposite side of this as most folks, where what I mean by that is I'm kind of with Trump, that I think that he can begin to cut more quickly than what they forecasted thus far. So what's interesting, though, is I was looking at this morning, just what the market expectation is for Wednesday. And obviously the far and away most likely outcome is no change. But I was thinking, okay, well, what is the chance of a cut on Wednesday? Is there? And no, it's 99.9% chance that they keep rates flat and a 0.1% chance that they raise rates on Wednesday, which I thought was very, very interesting.
Oh, so that's weird. I don't know if I remember a meeting where there was no cut on the table. It's only a raise or a pause. That's
That's what the current betting markets are, or not even betting markets. That's what the market's pricing in via options. So
yeah, absolutely. It's funny. I did some research over the weekend just to kind of get where the experts are for the year, and I have it here. I talked about it on the daily financial news. According to, let me make sure I get them right, Bank of America and Morgan Stanley have 0 cuts for 2025. On the other side of that, we have Wells Fargo and UBS with 100 basis points cut this year. It's been a while since I remember the smart money being still so dude, we have 4 meetings left in the year.
Yep.
And we got 0 and 100 still on the table.
Yep. That's 1 at every meeting and 0 at every meeting. It is. I mean, there is just so much noise right now, so much uncertainty. One of the biggest inflationary positive drivers, I guess what I mean by that is, with disinflationary pressure, has been energy. And we just got a huge, wrench in what's going on there with the Middle East disruption that we have there. And you saw oil pop, and it hasn't gotten out of control because there's been no real disruption there to meaningful passages in the seas that the Strait of Hormuz, is basically the epicenter linchpin there. And there's been no real change there. So no meaningful, huge movements in oil, but nonetheless, they've moved higher. And I would anticipate you seeing, prices at the pump go higher as well.
Yeah, I mean, certainly in the short term, I don't know how they could. And I think oil's up roughly 10% from Thursday close to Monday. Right. It is interesting, to your point, to see it kind of settle in. I think actually, as of right now, oil's trading down slightly as of the start of this recording. Not crazy, but down a little, which hopefully this means the skirmish is quickly going to be resolved, and death and destruction will be avoided, or more death and destruction avoided. But it is interesting to me, when it happened on Friday, I will admit I was shocked by one thing. I wasn't shocked by oil going up. I wasn't shocked by gold going up. But you know what got me was the violent move in rates up, right? And again, I keep asking myself, signal or noise? Signal or noise?
Yep.
And I'd love to get your opinion, because when the rates shot up, I'm like, what happened to the U.S. Treasuries being the safe asset?
Yeah.
Now, this could have been a knee-jerk reaction because maybe they see oil and that's inflationary and less. I mean, I could get there, but dude, I was left scratching my head going, this is not a good sign, right? They're taking it.
I think you're right on. It is an interesting one. And I think it goes back to the fact that there's just so many moving parts when it comes to interest rates, whether it's currencies, whether it's, the inflationary impulse is kind of what drove rates in the direction that surprised you, is my take on that. And we were having the same discussion here and saying, okay, well, what does this actually mean, et cetera. You look back to the original disruption that happened between Israel and Hamas, et cetera. And the market, stubbed its toe for a second on it. And then it just, said it's a non-issue, which is crazy, because these are, what are these? We've got a nuclear power at threat right now. And a back dog in the corner can do some things that, aren't indicative of anything, positive to the world, including the economies, which are not the most important part if nuclear comes into the conversation, to state the obvious. But the market is fully aware of it and fully saying non-event.
Yeah. Non-event, yeah.
But by the way, the market's been saying non-event to basically everything on the planet, so it's not necessarily a huge shock.
Yeah. So it is going to be interesting to me because, again, I think it's fair to say, again, based on the experts' opinion, last week's inflationary readings on CPI and PPI, 7 of the 8 readings were better than expected, with the 8th matching expectations. That's month on month, year on year core and headline. It's going to be very interesting. This next report that comes out in about 4 weeks is we're going to find out next month if tariffs are, has any inflationary, or is it just all demand destruction?
Yeah. What's funny is we have been saying those words for the last 2 months in a row. Next month we'll find out. Next month we'll find out. Next month we'll find out.
True.
And I think that probably you're right, but like, what really happened with tariffs? They went on April 2nd or whatever it was. Then they were pushed out. So they were like a week or two where they were actually present. And then they were pushed out and nothing, has actually been in place. And now, like, for the majority of May, all of May, right, it was still on delay. So, like, I don't know that we learn anything at any point, because we haven't really enacted tariffs in any meaningful way. China, I guess, is getting some, and we have a 10% on everyone during this delay, but it's not the arduous numbers that folks thought. And the 10% really has not had much of an impact whatsoever via the inflation data.
No, I mean, and also if you look at the other side, I mean, on a positive note, even if the 10% sticks, which it pretty much sounds like it's going to, that's the base for everyone, I think, is it's going to raise about $300 billion. Yeah. And, if you throw that against, our ballooning debt, that's not a bad thing, right? 300 billion, carving it off, get rates lower, carve off another 300 billion in interest, and throw in 100 billion from, Doge, and you almost got $1 trillion in savings. That's not bad, right? That's bending the curve.
Yeah. And it's funny. It's like, and full disclosure, like, I was in this camp as well of like tariffs. There's no positive impact of tariffs when you look at history and look at any scenario where tariffs have been placed in any meaningful way. But it's funny that we have not seen an impact. Like, we really have not. Yeah. There's nothing you can point out and say like huge material impact outside of maybe sentiment, right? Consumer sentiment.
Yeah, that was ugly for a month, but it's coming back. Friday's numbers were great.
Yeah, and that didn't really have any. It's funny when you ask people, how do you feel? And then you look at their credit card statement. It's like, those don't match. So it's like,
well, we're going to find out tomorrow, right? Retail sales tomorrow.
Is tomorrow.
It's going to be a big one, right? So that one's going to be interesting to me, because, again, I think we saw in the savings rate last month, I think this was 3 weeks ago, savings rate jumped big time from like 0.8 to almost 5%, which really shows the consumer being scared. But they don't act scared for very long. That's not the American consumer. So I think retail sales tomorrow might surprise people to the upside.
Yeah. What's the one kind of outstanding question mark, I think, that is not like a, alarm ringing, like get out of the house, there's a fire, et cetera, but just one to keep an eye on, I think, is and maybe we mentioned this last week, I don't even recall, is the continued claims for unemployment.
Yes. The highest in 4 years. Absolutely.
Yeah. So you're seeing that it's a no hire, no fire type market.
Yes.
So people aren't getting fired. Yeah. So the unemployment number isn't popping, but the folks that don't have a job maintain that no job status because they aren't being hired back. And this is probably a function of COVID, labor disruptions that took place there. And people said, hey, we're not firing people because we fired them during COVID and then we couldn't buy them back. We bought them back at a 4x premium to what they should have been. That's what we paid them. So I think that was kind of a lesson learned. And it'll be interesting to see that if you continue to see those longer term unemployed folks build, is that indicative of what's going to come on the unemployment on the other end? And that's up for debate.
Yeah, that's something I've been calling all year, is that this unemployment cycle is not going to be like the .com or COVID, where the unemployment rate shoots higher. It's going to be all about duration. And thankfully, I've been calling that for 6 months when this was 1.5 million. Now it's on the cusp of 2 million, and I think going to 3 million, where the unemployment rate maybe never goes above 5. But if you get enough continuing claims, that's a problem nonetheless.
Oh, it certainly is. And I would argue it's actually, well, it's not. I was going to say it's more important. It is more important to the individual that continues to not have the job for a longer period of time. And how long is it before they just get deterred from entering back into the workforce and kind of the psychological battle that comes along with that. But the unemployment on the front end is more important. The person that has a job that then gets whacked and no longer has a job is certainly more important.
Well, and also it'll be a change for the Fed, right? The Fed historically has reacted to the unemployment rate.
Right.
not duration. So this may be a, a thing. So let's talk about the SOP, also called the dot plot. Typically they talk about 4 things. We'll go to rate cuts. As I recall, and you can always correct me if I'm wrong, last meeting they put out 2. Right. That was the average, the blending average. Do you think that changes at all, or what do you think?
I think that's still where the market sits, and I think that's broadly where they'll sit as well. You've had some dissenting voices come out more vocally, I think, over the past couple months now. And that might drive a change there, but I still think that directionally they're going to be in line with the market. The data that has come through, that's the hard data, has been freaking consistent. Where unemployment isn't scary, inflation's not scary, and so therefore they're going to hold pat. I think I've stated my claim on this, and I'll stick by it, in the fact that I think tariffs are more demand destructionary than they are inflationary, and thus, I think that they could cut more comfortably sooner than they're going to, but they aren't going to do that. They're going to wait and let the data tell them what to do. And if the data doesn't move, they aren't moving.
Yeah, it's really interesting. I think you're right. I think the dot plot still says 2. I don't know that they want to shock the market either way, right? If they go to 3, then everybody's going to be about, oh my God, it's falling apart. If they go to 1, it's, oh my God, it's, anti-Trump or whatever. But I actually think the most important question about the dot plot is what I recall from the last meeting. There was 3 people of the 19, right? 18 districts plus Powell that said 0 or 1. I'm curious if that number goes up.
Yeah, it seems like it will in all likelihood. Again, I don't agree with it, but that being said, Taylor's not the most important person.
You're not one of the 19 with a dot?
I think it probably will, because you haven't seen any weakening in the labor market on the unemployment number. It'll be interesting if he talks about, and I'm sure he'll get questioned because it's coming up more in, pop financial culture, the continuing claims for the unemployment. It'll be interesting to see how he addresses that.
Yeah, he has to. I agree. That's something that I don't recall a session where that was a topic at hand. I certainly hope one of the analysts asked that question. So the next question I have to ask is about, let's go to unemployment. I believe the dot plot had unemployment peaking at 4.6 this year. Do you think there's any movement in that on the dot plot?
I think it's got to come down. Right?
It
really?
Has to
come down. Yeah, because you have not seen any progression towards that number. So if you don't have any increase in unemployment, the Fed might start to say, we're doing our jobs here. Hey, take a little victory lap on this. I would anticipate it coming down marginally. And maybe that's not the case, because you have the continuing claims that continues to be a little bit of a potential canary in the coal mine for the labor markets. But that would be my take. That seemed to surprise you. So what's your take on that?
I'm trying to figure out, because again, I know the dot plots. I think the dot plots are aiming at telling us a story. That's what I think they do with these.
Yep.
And again, I just can't see it coming down, because then again, that basically says no cut.
Yep.
Right. You can't square, right, 2 cuts, but unemployment's coming down, right? It's like, I don't get it. That just doesn't make logical sense.
You put more thought into that. I'm saying the numbers are leading me to believe that unemployment should be lower than what their expectation was. But you're probably right in the fact that, listen, if we're going to try to lean into a cut at some point this year, and bringing down unemployment means that the economy is stronger than what we indicated before, then that's probably fair. But maybe they're trying to walk back some of their cuts, though. And if they're trying to do that, then directionally they could say that unemployment's actually improving. Relative to where we think it could have been.
And I think that'll tell us part of the story is based on what that unemployment number is. I think that's very well said. So let's go to inflation. Again, I think a lot of the Fed presidents, like when the SOP came out last time, they basically said we just had to make assumptions. So I think we're going to get a lot more clarity on inflation, and is it bad? Is it worse? I think that's probably going to be a pretty interesting read from the Fed on where do they see inflation going.
Agreed. I totally agree with that. And that one, I am more comfortable saying that their expectation has to be that it comes down, because none of the inflation data has moved higher, right? So their uncertainty was a little bit of fear driven into it, that the fact that tariffs have to bleed through and you have to have prices go higher. But we haven't seen that to any meaningful degree whatsoever. The only stuff that went up in price was the obvious stuff.
Yeah.
Appliances, right? Okay, well, they're all made overseas. So like we know that's going to move. So that it was just the very evident stuff in the market that was a direct. There was no knock on. And I think that was the real fear of the Fed, that all of a sudden it wasn't going to be just the obvious components that saw a price move higher. It was going to be a bleed through and a broadening of it. And we have not seen that whatsoever.
I like it. And then the final one will be GDP. Obviously, we got the first print or second print on Q1, which is negative 0.2. GDP now looks at, I think it said 3.8 last time I checked.
Crazy, yeah. Crazy,
right? Three plus. Yep. So where do you think they got GDP the rest of the year?
Where was it last time? Do you recall?
I think it was 2.1. I think 2.1 if I recall correctly.
Yeah, and so since then we got the negative print, or was that after the negative print? The last
we got the second print. So the first one came out negative 0.3.
Gotcha.
It's been revised to negative 0.2.
Adjusted, revised there, and then yeah, I mean, to your point, GDP is such a difficult one to try to predict because there's just a nonsensical way of calculating it, right? Yeah. The fact that like some stuff got pulled forward and inventory stacked in the first quarter, that threw us into a negative GDP. And is that indicative of a good economy, a bad economy? Like, I don't really know that that's a direct, okay, because we imported more stuff, therefore our economy's in worse shape. Now, if that stuff sits on the shelf and doesn't move, I do agree that our economy, or more importantly, our corporate earnings are going to struggle based upon that. But it's really tough to ascertain that. But to the early indications of the Atlanta Fed, who is using just calculations, just quantitative, no qualitative overlay on it whatsoever, it looks to have improved. So with that in mind, like the first quarter was nasty, but a lot of that was a wonky behavior of the imports. It seems like things are directionally trending towards the economy being on more solid footing than what they had anticipated before.
I agree. Well, it's going to be a lot of fun. It is Fed week. Give us your closing thoughts. And of course, where can people find you?
Yeah, I think this is going to be a big nothing burger.
After all of that,
I hate to say they're just going to continue to say, we don't know. We need
more uncertain.
Data. We're uncertain. We're going to follow the data, etc. And this is one where, like, for a while, these things were freaking exciting. Like, what are they going to do? They're going to raise by 0.25. They're going to raise by 0.75. Like, how crazy do they think this inflation is going to be? And now they're back to being tempered and pretty consistent. So I think that they're going to go with the vague language and let this thing continue to roll until something tells them with some sort of certainty which direction to go.
Very cool. And Taylor, where can they find you?
Yeah, find us at Life Goal Investments. We're on Instagram, on TikTok, on LinkedIn. Go get us there.
Yeah, go follow him on Instagram. Puts out these 60-second clips, which I swear have 5 minutes of content in them. I have no idea how he does it, but it's awesome. Thanks, buddy. Take care.
You're the man. Thank you.